Nick Griffith.
Yes, here in Kalamazoo County.
Thank you. Joshua Sledge.
Here in Kalamazoo County.
Dan DeMint. Oh, Dan, you're muted. There we go. See if I can.
Dan, just give us a thumbs up to show us you're here.
Yeah. Okay.
And I think Dan's in Allegan County, are you not?
Okay. Perfect. Dean Berge.
Here in Kalamazoo County.
Randy Everett.
Here in Kalamazoo County.
And Chairman Bob Salisbury.
I'm here and I'm in Watauga County, North Carolina.
Okay. And then I'll just note that Sandy Doctor is not present today.
Right. And can we have a motion to excuse Sandy, please?
So moved.
Support.
Support.
Motion, support, all in favor, signify by saying aye. Aye.
Aye.
Aye.
Sandy's excused. Steve, could you do introduction of guests from the city, please?
Sure. So today we have City Attorney Clyde Robinson and Mayor David Anderson.
Welcome. And Chris, could you introduce the guests from Marion Capital and Zang, please? Chris Ruppel, are you there?
Yep. We've got Kyle and Lynn Zhang from Zhang Financial, Katie, and Rob is on the line. So we're good. Problem.
Okay. Thank you. So I'll move next to the approval of the minutes of the May 26th meeting, which were included in your package. Can I have a motion to approve them?
Move approval.
Support.
Motion and support. Any discussion or correction of the minutes? Hearing none, all those in favor of approving them signify by saying aye. Aye.
Aye.
Aye.
Anyone opposed? Minutes are approved. So we'll next move to the investment portfolio assets as of June 30th, Steve.
Okay. Can everyone see my screen okay?
Yep. Yes.
Okay. Okay, so we can see here the total assets on June 30th were 936 million, with our split of just under 781 million for the pension, just under 117 million for Opeb, and 38 million for CCTA. So if there's any questions about that, or else I don't like to begin too far into it because we just cover it in the next section here.
Steve, just real quickly, how long has OPEB been in existence? I forget now.
2015 is when we started. We started with $90 million. So we've been able to pay benefits out of there and increase that overall amount.
Okay, and the city is still paying the interest on the loan, is that right?
Yeah.
General.
There's about $81 million in debt left, and that'll expire in 2042.
Okay, thank you.
Okay, let's move on to investment performance, Rob.
Okay, so Steve, are you driving there?
I am, dude.
Okay,
I can
great.
just kind of go with you, or
Yeah, that'd be great. It's very helpful. So thank you for doing that. So the summary on, I can't see the page 9. The market value of the portfolio grew from 897, and as Steve mentioned, it's at 936.1 million at the end of the second quarter. That was an increase of 39.1 million, or 4.36%. The weighted average return for the quarter net of fees was 5.47%. The one-year net return was 34.05%. And the annualized return since 1982 net of fees through the end of the quarter was 11.01. At the end of the quarter, equities were 70.1% of the portfolio. During the quarter, equities were up 6.53%. On a year-to-date basis, they're up 18.66%, and they're up 50.01% for the last year. At the end of the quarter, fixed income was 24.9% of the portfolio and returned 1.57% during the quarter, was a negative 2.09% on a year-to-date basis, and negative 0.58% for 1 year. Real estate at the end of the quarter was 5% of the portfolio. It returned 7.6% in the quarter, 13.46% year to date, and 19.63% for 1 year. At the end of the quarter, again, equities were 70.1%, fixed income at 24.9%, and real estate at 5.0%, almost precisely on target with the allocations of 70, 25, and 5% respectively. The inflation adjusted or real return in the quarter was 2.9%, taking into account inflation of 2.57%. For the 1 year, inflation was 5.39%. Therefore, the 1 year real return was 28.66. And since October of 1982, the real return on the portfolio has been 8.34%. We go back 2 pages with the pie chart showing the allocation, 19.9% in international. Everything is in US dollars. Again, the asset allocation is almost precisely on target. We see that in the lower left-hand corner. Liquidity, 97.7% daily liquidity on the portfolio. To the right of all that is the fixed income metrics on Jennison. We'll go through their performance more fully a little bit later in the packet. Just mentioned right now, they were under their benchmark by 30 basis points during the quarter. Next page simply is thank you, Steve, is the quarterly returns. And we can see after what happened, the COVID-induced downturn in the first quarter of 2020, we've had 5 consecutive quarters of up markets, positive returns for the portfolio. Next page, page 13, is simply showing what I've mentioned already, that the allocation in total is very close to the target allocations. The only one that's slightly above is Blackrock at 53 basis points ahead of the policy allocation of 30%. If we move to the next page, in terms of equity returns during the quarter, very solid. I'll just say from a macro standpoint, US equities during the quarter, large cap outperformed small, and growth outperformed value during the quarter. The portfolio did very well though, total equity up 6.53%. And as I mentioned, large cap led the returns within equities, and you can see the S&P 500, the Blackrock fund, led equity returns at a positive 8.54%. On fixed income, mentioned Jennison was a little bit under its index that we'll talk about, but was a positive 1.57% in the quarter. And on the real estate side, I've got 2 things to mention here. One is Vanguard had a very good quarter, up 11.67%. So total real estate for the quarter up 7.6%. One thing I have to mention here, and we'll have to follow up on this, Katie is working on this, but the Reef return stated here at 2.89%, to the best of our understanding, is incorrect. We're trying to get a determination from State Street, but if you take a look at both the foundation and take a look at the county returns, I believe they were almost, I think, 80 basis points higher. And so we're trying to reconcile that, and we will get back to you on that. So when we take a look at Reef versus its benchmark, those of you that have been watching for some time, their tracking error is very slight to the benchmark. It's usually just a couple of basis points either way. In this case, it looks large. And again, I believe it's because that 2.89% is understated. Again, Katie, if you're on the call, if there's any update from State Street on that, you can pipe in. If not, we'll continue to work on that and report back to the committee when we reconcile that number.
Do have a response. They're looking into it right now, and they're going to get back to me with their accounting team to reconcile and hopefully fix for future quarters. That's all we have so far, but I did get a response from them late last night.
Right. Okay. Thank you, Katie. So if there are no questions on that, we'll go to the returns versus the benchmarks on the next page. DFA portfolios did well in the quarter. 3 outperformed. 1 was in line. 1 was slightly under the index. The one that was under was the U.S. small cap value. The reason for that is not the size factor, it's actually the value factor. It definitely has value characteristics stronger than that of its benchmark, which is a Russell 2000 value index. And as a result, they underperformed by 62 basis points. If we go to the next page, we see Jennison again with a negative 26 basis point variance to its benchmark. We'll talk about that again just a little bit. The Vanguard fund did well. Again, the Reef, as we show here, negative 81 basis points. I'm pretty confident, unless there's something I'm not understanding that's not correct. The other 2 portfolios were right at the benchmark. So again, we'll report back on that. In fact, I do have the number of both KCO, the county and the foundation. The returns were exactly the same. It was 3.69. And as we show here, Reef is at 2.89. We'll clear that up for you. We go to the next page. This is the 5-year benchmark standard deviation ratios for the funds. Again, there are some red, of course, on the DFA numbers. It was a tough 4 years until there was a reversion back to both small cap and value, a little bit in the 3rd quarter, very pronounced in the 4th quarter of last year. So while these 5-year return numbers versus the benchmark are still largely negative, for the DFA funds, certainly with the exception of, well, emerging market and US large value, these have improved considerably over the last 3 quarters. So the Jennison I mentioned is under for the quarter. We'll talk about that again more. But over the last 5 years, that plus 0.33% above their benchmark is a very strong performance. Vanguard REIT has done very well versus its index. And Reef, as we show it here, the 5-year, again, they track pretty close to the benchmark, but have outperformed their benchmark over the last 5 years. And this includes that lower number that I referenced earlier that we're looking into. So the composite benchmark was up 5.34%, meaning the portfolio outperformed that by 13 basis points. You may recall in the 1st quarter, due to DFA, small cap and value being in favor, a huge outperformance. So on a year-to-date basis, above that benchmark by 1.93%, and the 1 year now positive at a positive 1.15. And the rest of the metrics, 3, 5, 10, and 15, have improved greatly over the last 3 quarters. Next one, Steve. Yeah, again, the real return, which I had mentioned, shown here, 8.34% since 1982. Very strong. The next slide. Correlations, we talked a little bit earlier, but international, the variance between that and the S&P 500, it's very strong correlation at 0.92. We are talking about looking at asset allocation and changes, potential changes going forward. So that's something we will have to take into consideration. Historically, certainly 20 years ago, 10 years ago, the argument for international has always been it's not perfectly positively correlated with US markets, and therefore, even if it underperforms the US market, it can have benefits because of lower correlation turning out, resulting in lower standard deviation of returns for the portfolio, and therefore a better Sharpe ratio. But the international markets have definitely performed much closer, much tighter correlation with the US market. So that's something we'll be talking about during the asset allocation study. The other thing on this page is just to point out US microcap from DFA and the small cap value are, the correlation is 1.00. So those 2 funds definitely move in lockstep with each other. If we go to the next page, page 11, shows the alphas still negative for some of these DFA funds. Again, we had 4 really tough years after, I think 2016 was the last year value outperformed until last year. So until we run some of those years off, these numbers are going to be negative. They are a 5-year look back. But again, reiterate the point, they've improved dramatically over the last 3 quarters. The next couple of pages are just the selected names for you to take a look at the benchmark, compare against some other assets that have been talked about or held during time or of interest. If we go 2 pages forward, the plot here is showing risk return on the portfolios for the 5-year. The only thing of note is the real estate funds. Vanguard has outperformed the private real estate a little bit. Not much to talk about there, but the point being is that the private real estate, they only revalue their portfolio on a quarterly basis, and therefore their volatility is suppressed relative to a publicly traded entities such as the Vanguard Reef Fund. I would think those 2 plots would be very close to each other if they were both public companies or they were both private. The benchmarks, nothing to say here. We believe the benchmarks that we're using are the appropriate benchmarks for each of the assets held in this portfolio. I believe that's it for me at this point, and I'll be back to talk about Jennison and derivatives in just a bit.
Okay, any questions for Rob before we move on? Hearing none, we're going to move to a review of expenses. Steve, would you take us through that, please?
Absolutely. Okay, so here we start with our expenses. Our pension system, starting our payment to retirees and beneficiaries, still pretty on target for what we're used to. Did have 1 withdrawal this quarter. As I noted from last year, last year we got caught up with those, so that the amount of participant plan withdrawals has been reduced significantly compared to prior year. That just is getting caught up with people that have retired that are outside or may want to either roll it into a different fund or just withdraw their funds from the city for one reason or another. Continuing, we had, all of our actuary reports came in this quarter, so you see a large increase in actuary fees as expected that go along with that. Admin fees, consulting fees, all on par with what the plan is. State Street, they had got us caught up in the last quarter a bit and then kind of slowed down again, and we're only through February, so only 1 payment to them for custody fees for this quarter. Continuing on, manager fees, all as expected. The one note with Blackrock is in the first quarter we paid 2 quarters worth. We paid the 4th quarter and the 1st quarter, and then the 2nd quarter here, the 3rd and 4th quarter at the same time, and then the 2nd quarter we paid the 1st quarter invoice. So a little bit of catch up in that 1st quarter, which is why that number is doubled. Otherwise, largely on par with what we would expect given the size of each of the funds and the normal billing cycles that we're used to. Jennison again kind of returning to normal because we did have that correction for 2020 duplicate billing that reduced the 1st quarter, and in total right on par. And again, $8.7 million in expenses for the pension fund. Continuing on, looking at the Opeb Fund. We're still working through some run out from our old retiree healthcare plan. Now that we're on the new MAPD plan, we hope to see these healthcare benefits continue to decrease. But on the other side, we've seen the premium benefits increase. There is a bit of catch up here with the new billing cycle taking place and getting used to or getting on the same page with Blue Cross Blue Shield from the beginning of the year. So that'll start to steady off as we get through the rest of the year. Again, actuary fees here. We had our audit fees for our Opeb audit and everything, and consulting and custody fees, again, on target. State Street, again, still only billed through February for custody fees. And then continuing on with fund manager fees, obviously very similar to the pension, as it's just an allocation on those those fees depending on the amount in each fund at the given time. So in total, I would ask for approval for $2,609,390 for the Opeb Fund, and let me go grab the number here. $8,704,995 for the pension fund. So if there's any questions, just request approval for those amounts.
Could I have a motion to approve those?
I'll move approval, Bob.
Thank you, Dean. Motion and support. Any discussion, comments, or questions? Hearing none, I think we need to do a roll call for approval of these, Steve.
Okay. Nick Griffith,
Yes.
Joshua Sledge,
Yes.
Dan DeMint,
Yes.
Dean Berge,
Yes.
Randy Eberts,
Yes.
and Bob Salisbury.
Yes. Motion's approved. Thank you. So Steve, let's move to cash flow, please.
Okay, moving into the cash flow here, we see employee contributions for the second quarter a little bit higher, as planned, based on just the timing of payrolls from the first quarter. Benefit payments, again, on target with what we're planning throughout the year. Other categories, again, we're seeing less participant withdrawals, so we may have overplanned for that, but that's generally a good thing. Actuary fees still kind of on target for the year as we go through. Consulting fees, custody fees, again, those both are tracking with our targets for the year. We did have, custody fees will likely end up a little bit higher than planned just because of that catch up in the first quarter, but we'll see kind of where we end up with the billings at the end of the year here. Moving on, investment return as a whole, significantly better than original plan. I know there's some discussion on this at the last meeting. The way we've kind of planned the investment return is based on the 7.25% per the actuarial report or actuarial projections. So always good to continue to outpace those. I know there's one question on how we plan the dividends and interest, and I will say I did look back. We did not translate our notes here. In total, we're still targeting that 7.25% for investment return, but in the pension fund, we did not do a good job of allocating those returns to the proper buckets. As we continue through, you'll see in the Opeb fund, we actually did translate our notes and are much closer to planned budget and targets for those cash flows. Kind of jumping into the Opeb fund here, employer contribution and retiree contribution still on target. Health benefit payments are slightly lower than originally planned. However, I do expect that to continue to decrease as we get fully vested into the new plan and completely out of the runout phase of the old plan, which runouts, they tell you, are typically 4 to 6 months for a healthcare plan. So we're right on the precipice of that. So as we move forward, hopefully that number will continue to decrease. As I said already, premium payments a little bit higher than perhaps originally anticipated, and that number will, looking forward, will likely end up higher than we anticipated. But I think in total, per our actuary reports, as we'll talk about in a little bit, we are trending in the right direction for total expenses here. And again, overall investment returns here are significantly better than our original plan. So if there's any, I'll open up to any questions or thoughts on the cash flows.
Any questions for Steve on cash flow?
Steve, I don't have a question on this specifically, although I might have one when we come back to the actuarial reports. But one thing is just relative to the overall packet here. The one thing I didn't notice was pages on liquidations, which I think would normally follow this, but am I missing something?
You are correct. Normally we do have those in here. We must have, my apologies, we must have missed those in the packet completion this quarter. I can pull those up here while we're discussing.
So Steve, well, let's deal with the actuarial reports. Sure. And then when Chris is talking about some of his due diligence things, then you could pull up those other items.
Okay, sounds good.
Good. That's a good catch, Dean. Thank you for noting that. Let's talk about actuarial reports, Steve.
Okay, here, I'm going to stop sharing my screen since I'm not going to put those up on the screen at the moment. So largely good reports. We're still over 130% funded on our general pension plan. So we're staying in line there, even with the new assumptions as we move forward. And just a reminder, some of those assumptions were, different mortality tables and using the 7.25% return versus 7.5%. The one highlight I'd like to point out is our Opeb, using our standard report basis, went from 51% funded to 75% funded. That's a saving of roughly $60 million on the actuarial liability. So moving forward, in a much better position there. I'm extremely interested this year as we'll get our GASB basis Opeb report, which projects out how long the fund will stay funded for. And that'll really help with our long-term planning in that fund as we determine, how to handle that remaining 25% of being underfunded at the moment.
So one thing that I noted, Steve, in the actuarial report for the pension is that, it's still very good news, very well funded. But they keep saying that someday you'll get down to close to being 100% funded rather than being significantly overfunded. I know they've been promising that for many, many years, but I guess they'll say that someday that'll happen and we'll have to start making contributions again.
Yes, and I think partly I do look at that with a little bit different view too. They do amortize whether we have a liability or an overfunding. They amortize that over 10 years, regardless of which way it is. It's not my ideal way of thinking about it, but I do understand that it is the norm for the business. So they always project us that after about 10 years that we will be at about 100% no matter which way we are.
Okay, so that's a good point. I'm glad you noted that. And I think the important thing to note for the city is that my recollection is that the normal cost is somewhere around $6 million a year for the pension fund. And so, that you could view that as being the long-term cost of providing the benefits, but at the same time, we haven't made a contribution for many, many years. So that is quite a savings for the city that otherwise would be part of your budget.
Absolutely.
Steve, real quickly, I was noticing on A1 of this report that it says if the plan is less than 120% funded, then employees have to contribute. Is that?
So we do have employee contributions where we're at. When we do reach the 120% funded, we do have some union agreements that would increase the amount of employee contribution.
Increase it.
So there are,
okay. Yeah. Okay.
Yes. So there's a trigger there. So
this,
they are contributing now. There is an increase that would happen.
Yeah. Okay, so there's an increase after 120% for the employees, but it's 100% employer for the city. Is that what it is?
Correct.
If it falls below 100%, okay. Just one.
Other comments or questions for Steve on the actuarial reports?
Steve, my question is on the OPEB plan. As I look at this, it's probably just not a full understanding on my part, but it says that the actuarially determined contribution is $4.2 million, and yet this year we're projecting to contribute $1,750,000. Can you help me understand that difference?
Sure. So the $1,750,000, trying to remember, I believe that is the employee portion. Let me see. I'll pull that section up here. You're on A1.
I don't know. I'm on page 8 of the report, but there's different. It's probably mentioned in different places. So,
okay. So it is a bit of a tricky situation there with the way that gets accounted for, because for a lot of different reasons we're considered doing pay as we go, even though we are contributing and then we are anticipating utilizing investment return to help cover that gap. But we're also, even though we're pay as you go, it's kind of odd because we do have the bucket of funds there from the bonding. So I think that difference is just because, right now we are contributing $3.5 million among all the groups out of that $4.2 million determined contribution. So I guess kind of returning to that, I don't know if I've answered your question. I'm sorry.
Yeah, I mean, so it sounds like you're saying in total amongst everybody, we're contributing 3.5, and this is 4.2. So we're kind of in the ballpark. Because it's pay as you go, we're not necessarily required to contribute that, but that's what might be suggested to stay on track. Is that a way of thinking of it, or not necessarily?
Correct. So that 4.2 would long-term plan to get us to the 100%. As I kind of said, I alluded to earlier, I was interested in seeing the gas report at the end of this year. That'll really help with our long-term planning because, there's a lot of different ways we can look at it. One thought is that depending on how long that gas report projects that we will have funds for, we may be in the future able to, once the bond runs out, take those amounts we're contributing toward the bond and contribute that towards this plan, which 20, 30 years from now, this plan will likely have significantly less requirements because there will just be less users active.
Okay, that's helpful. Thank you.
Yep.
Other questions on the actuarial reports? If not, Chris, can we move on to activity reports on page 35? And Steve, while he's doing that, you can look up those liquidations.
All right, there were 3 activity reports, Jennison, Blackrock, and Vanguard. With Jennison, they are active fixed income managers. They are investing according to their mandate. The only point that I would make is they are repositioning the portfolios at this point. They're going a little defensive. And I think Rob covered that a little bit and probably will cover that when he covers the fixed income reports. We'll jump to Vanguard. Vanguard was, again, low cost, low tracking error, and very passive. So there wasn't really a whole lot in there. We had a good discussion on fixed income for the Reef versus the Vanguard public REIT. The public REIT, including materials or areas like timberlands and cell towers, which Reef does not. I think there is a place, as Rob said, I think there's a place in the portfolio for both of those. We were strictly physical properties with Reef, but I think there is a place for the rest of this. But in Blackrock, I would like to chat a little bit about that, particularly on the study that we had Blackrock do for us. And that was the CIU study for peer review. And the points that I would make there is the city was 134% funded, which was in the 96th percentile of all of the 98 plans that Blackrock reviewed. The county was 113, and they were the highest 2 with one exception, which was a plan that only had 2% of its participants active, and it was 98% they were either inactive or retired, and so that skews that coverage ratio. But other than that, the other interesting point was in going through the proposed asset allocation. I mean, going forward, there was a great deal of emphasis on private equity, but what you're using is not even CAPM numbers for the forecast. You're using numbers that Blackrock themselves created and used in their model. So it really looked like private equity is a major driver in the future. That's really quite spurious. You don't really know. So and that's really about all I have for that. We'll use some of that information as we proceed in the asset allocation review.
So I'll just pick up on this for a moment to say that we've in this time period where we've had to do everything virtual, we've been doing virtual due diligence meetings with all of our managers. I think we only have one to go. And I think the process has been working very well for us so that we can stay in touch with what's going on with the managers. So I think we are continuing our responsibility there. Future due diligence, Chris, what would you say there? We just have one to go?
We have Reef to go formally, and there may be or may not be a DFA conference in October in Austin. We'll have to see. I think they're rethinking it with COVID spiking again, so we'll see. And that will be a choice on the basis of each individual member of the committee.
And anything on corporate governance, Chris?
Just that Reef restructured. They didn't really restructure. They put in some proposals, and the proposals were to more realistically align Reef performance with the NCREEF ODCE benchmark. And so they had some proposals, some amendments to the charter. And one was on the ability to increase leverage from 30 to 35%, which is where the benchmark is. And we voted positively with management on these proposals. So that's all.
Okay, let's circle back. Steve, have you been able to pull up the liquidations numbers?
Yes, I have them. I can share my screen here. Okay, so here we have the April liquidation. As you can see, we liquidated out of DFA microcap and small cap as they were the most significant above their target values. Gotta move this on. There we go. In May, we ended up having to do a rebalance because we were outside of our overall equities of our target of 3%. So our equities were over their allocation of 3.1%. So we did a full rebalance here in May to kind of balance out the funds across the board. And then in June, again, back to, we liquidated out of Blackrock and then out of Reef. Sorry. No, we did not liquidate out of Reef. Sorry. We liquidated out of Vanguard and then we ended up funding into Reef. That's how that one worked. I'm sorry. I read that backwards. And so that was the liquidations for the quarter. Any questions on those?
Any questions for Steve? Okay, are those all the liquidations, Steve?
Those were the 3 liquidations for the quarter.
Okay, thank you. I'm watching time and wanting to reserve some time for discussion, so let's move on to derivative reports in the Jennison quarterly review. I think, Rob, you're going to do that, and let's see if we can keep that on a condensed version, please.
Definitely will. So the first report is on the Blackrock 500. They use very little derivatives. It's just for cash. They put it in S&P 500 futures. It represents 23 basis points of the portfolio. Quarter over quarter, that the notional value is actually down 36%. So nothing to report there for sure. The next page on Jennison. Jennison, of course, fixed income. They use derivatives quite heavily. If you take the net or the total, the gross notional value, it represents 52% of the outstanding balance. And the derivative usage went up quarter over quarter by 12.9%. So if we want to go to the next, which is the Jennison performance, very quickly, they were down 31 basis points to their index. And almost the sole factor on that was the fact that they're overweight 7 years. 7 years underperformed relative to 10 years. And 10 years, they're significantly underweight. I believe those are on page 44 showing those levels. So that combined with the fact that the duration of the fund is 0.35 years less than the index, those two factors account for the entire 31 basis point shortfall. In terms of positioning, the fund is overweight treasuries. They're dramatically underweight mortgages and overweight credit, but within credit, they have higher credit quality than the index. In terms of credit, they point out that credit spreads have decreased significantly since the end of COVID last year. And now for credit spreads, we're at the levels that we were back in 2005, which is just before the housing crisis. As a result, they haven't started this yet, at least as they wrote the recap for the quarter, but they are considering that if the Fed Reserve continues as accommodative as they have been, that they will move to get rid of their overweight credit by about 7%. They expect to decrease that and go to an underweight position. They will do that gradually. Their preference right now on the credit side is definitely towards high credit quality, because with the credit yields, the spreads being as tight as they are at this point, you are not getting paid to take risk.
So I think the long and short, we learned this from the Jennison due diligence meeting that they are an active bond manager. They're continuing to manage their bonds as we expect them. They've had a quarter of underperformance, but their long-term performance continues to be very good in the active management. So I think we're comfortable with the steps that they're taking.
Yes, I agree. Thank you. I think
Articles of interest, Chris, can you give us a quick summary on those, please? And a reminder, you're muted.
BlackRock is recommending to the SEC to expand the definition of the investment process, something we're talking about. Interesting little article. There's a letter pertaining to that from Toomey and Johnson to the SEC, saying that BlackRock and State Street are not discharging their duties solely in the interests of the participants of the beneficiaries. That'll be an interesting conflict to follow. And the last one was a relatively lengthy study by Lubos, but essentially the takeaway is that green assets are performing unexpectedly high returns at this point, but they surmise that this is reflecting asset cash flows into the sectors and not long-term high expected returns. And that's really about all I've got. There's something to watch as we go through this.
So I think that's a good segue, Chris, into the next item, which is our asset allocation discussion. So just to let you know that our committee has been having ongoing discussions on the question of asset allocation. We've had some discussion with Chris about setting some parameters for what we would consider and what we wouldn't consider as potential asset allocations, so that Chris is going to be in a position to give us some alternatives to look at in the coming weeks. I think it's important from the standpoint of the city to understand that even the city has separate pools of asset. You have the pension funds where, at least at the current level, it's our understanding or interpretation of the fiduciary requirements that we invest the funds solely for the benefit of plan participants. And our interpretation of that at this point in time is that that does not include consideration of other factors such as the environmental, social, and governance. So it's called ESG. Although I think we are aware that there are some plan participants that have taken a broader interpretation that says you could include that. I don't think we've reached that point yet. But I think we are understanding that with other pools of assets, which go beyond just pension, I guess it could include Opeb, but it certainly might be relevant when we get into discussion for the FFE. And we know that the Kalamazoo Community Foundation is interested in some other things, that our one-size-fits-all approach for all of the funds that we manage through the various organizations, the city, the county, and the community foundation, may not be appropriate going forward. So we are going to be open to having some different asset allocations with possible inclusion of things like ESG for some of the different sponsors. So that may be an element of the future that you might see with us. I think we did rule out the idea of active equity management. That's something that we still don't feel there's something that we want to pursue. We probably will continue with active fixed income management, but that's the stage that we seem to be at in terms of pursuing this asset allocation discussion. I'll stop and ask Chris and any other committee members if there's some issues that I might not have just mentioned in that quick summary.
I'll just go through a real quick summary. We'll really try and follow the investment policy statements for each of the sponsors. The asset allocation may or may not stay at 70-30 or 70-25-5 as we go through this. We will look at liquidity. If we go into some of these private equity pools, it may be reduced to liquidity. We'll take a very close look to see whether there is whether you're getting paid for that liquidity premium. We've pretty much ruled out long shorts and we've eliminated derivatives. And on the basis of that, we will formulate some proposals for future asset allocation for consideration.
Thanks, Chris. Any other committee members want to add to those comments? It doesn't appear that way. Steve, looks like next on the agenda is public comment.
Yes. And Neil, is there any public comment?
No, there's no public comments at this time.
No, thank you.
Okay, thanks. Thank you. So Katie, let's do the Perk Care report, please. And Katie, you're muted, so there you go.
It took a double click. Okay. Oh, thanks, Steve, for sharing. I appreciate you doing that. All right. Get my screens up. Okay, perfect. So starting out on the narrative, during the second quarter of 2021, the perpetual care assets increased from $4,049,981.08 to $4,160,325.78, a dollar increase of $110,344.07, or 2.72%. There were no additions for the quarter, and withdrawals equaled $75,696. For the quarter, the portfolio had realized gains of $3,938.28 and unrealized gains of $159,165.58. There was no interest income for the period, and dividend income was $22,936.84. The perpetual care assets had a net return of 4.61% for the quarter and 18.18% at 1 year. The three-year annualized time-weighted net return was 8.43%. At the end of the quarter, equities comprised 52% of the assets, with 47.9% in fixed income and 0.1% in cash. The target is 50-50 equities versus fixed income. The international and US equities returned 6.84% for the quarter, 38.28% for 1 year, and 11.11% for 3 years. Fixed income returned 2.23% for the quarter, negative 0.19% for 1 year, and 5.69% for 3 years. The portfolio has returned 6.55% net of manager fees since inception of December 5th, 2006. The US BLS CPI inflation was 2.57% for the quarter and 5.39% at 1 year, resulting in portfolio real return for the quarter of 2.04 and 12.79 year on year. Since inception, the assets have had a nominal net return of 6.55% and an inflation adjusted or real return of 4.48%. On page 1 of 12, which is the pie chart page, thanks, Steve. We can see that the foreign allocation of the portfolio is 10.2%, which is slightly less than last quarter and about half of the city pension allocation. Just below on the left-hand side is the asset class allocation. Equity is over target by 2% and fixed income is under by 2.1%. On the right-hand side of this page, we can see that the credit quality is still very good, all BBB and above ratings, just like last quarter. If we move ahead to page 2 of 12, our policy versus actual holdings, the variances to target on an individual asset basis are fairly small. The Vanguard dividend growth displays the largest variance to target. The last page I'll touch on is page 4 of 12. One more, Steve. Thank you very much. We can see that the DFA US large company was the equity winner this quarter at 8.54%, and the DFA inflation protected securities was the fixed income winner at 3.18%. The overall portfolio net return for the quarter was 4.61. The 1-year return still captures our rebound period from last year's really poor performance due to the pandemic. And for the sake of time, I won't go into detail on the next 2 pages, which display funds against their individual indexes. But I know Rob wanted to touch on one of the funds versus its index. And the last couple pages are just the selected names, which you can review at your leisure unless there are any questions.
Rob, you wanted to comment on one particular manager?
Yeah, very quickly, Bob. Steve, if you can go back up to the page that compares the managers versus the benchmarks. The tracking error on the Vanguard dividend growth portfolio had been large, and we had a discussion with Vanguard just yesterday, and I brought that up, and they were kind of quizzical about it. And the reason being is that the prospectus benchmark is not the Russell 1000, which we show here, but is actually the NASDAQ US Dividend Achievers Select Index. So I did run those numbers against it, and Vanguard Dividend Growth product on a year-to-date basis is 95 basis points ahead of that index, 16.8, it's same returns, but 95 basis points over that index, and they're also above for the 1 year, the 3 years, slightly under for the 5 years. So bottom line is, we'll come back to you next quarter when we're going through this. We'll just show you the benchmark page. We will make this change. Of course, it's going to make the relative look better, particularly the quarter and the 1 year. Returns on everything are accurate here. It's just the benchmark that really needs to be changed from Russell 1000 to the NASDAQ US Dividend Achievers.
Okay, thanks for that clarification. Any questions for Rob or Katie on the Perpetual Care Fund?
Rob, real quickly, or Katie, what's the equity to fixed ratio here, or percentages? Is it 70-30 or 70-25-5? No, it must be much smaller, right? Because we have so.
No, we went to close to 50-50, I think, a year or two ago.
Is it 50-50?
Yes.
Oh, did we? Okay.
Yes.
I was just curious why we had so many fixed managers.
Yeah, it's 50-50 as of a year ago.
Yeah,
As a
it
year
was
ago. Okay.
rebalanced 12-17-2019. Switched over to the 50-50.
Okay.
Yeah.
It was just there were so many fixed managers. I was just wondering why so many.
I have a quick question of Steve. Are we pretty much keeping up with what your expenses are in this, Steve?
No. And I don't put the blame here. Our expenses have increased in the Perpetual Care Fund. The city did take steps last year to increase fees for the first time in over a decade. So we had fallen behind on our portion of keeping up with that. So I think, with the steps that we're taking, with where this fund is currently at, I think long term we still are okay, but I will continue to monitor that as we move forward.
Okay, thank you.
Any other questions on the Perpetual Care Fund? I'm going to the next page on the agenda where the future meetings are noted on here. And Clyde, I assume we're still virtual in December, or do we have to go back to regular meetings?
You are still virtual through the end of the year.
Okay, and we'll keep posted on that. I'll go around the table. I have nothing. Randy, do you have anything?
No, nothing, Bob. Thank you.
Dean?
Nothing, Bob.
Dan?
Nothing.
Nick?
Nothing.
Josh?
Nothing.
Chris?
Nothing.
Steve, anything? Anyone else from the city have any issues they'd like to bring to our attention?
Mr. Salisbury, I point out, and I would buttress the remarks you made earlier regarding how the assets can be assigned in terms of investment. I think that you're absolutely right. There are, because of the fiduciary responsibility in regard to pension funds, I think that you've got to try to maximize the investment opportunities. And if that means you can look at socially equitable types of investments, that's fine. But again, you've got to look at what is best for the pension system. The other, and we just finished discussing it, there are some statutes that go back to 1937 that talk about perpetual care funds. Again, there is the obligation to that fund is to reduce the obligation on the municipality to fund cemeteries through its general fund. Again, I would also say that you're somewhat restricted in how you can do those type of investments for perpetual care. On the other hand, as you point out in regard to the Foundation for Excellence money, you've got a little more flexibility.
Well, thank you for clarifying that, Clyde. That's very important, and we'll keep following developments on those.
Can I ask Clyde a quick question on OPEP? You didn't mention that one. I was just curious. Is that one the same as the pension plans?
I would, again, I'd have to do a little bit of research on that one. But again, the whole purpose of the OPEB is to reduce the city's exposure. And again, you should try to see what you can do to maximize that return so as to eliminate a further burden on the taxpayers.
Okay, thank you. Anyone else like to make any comments?
David Anderson here. Just wanted to say something quickly. Just relative to discussion, Mr. Salisbury and Mr. Berg, also relative to the actuarial study and comments related to the fact that the city would be funding out of its general fund a very, very significant payment on an annual basis. It just reminds me again of how it is often this quiet, detailed kind of behind the scenes work is what allows, the city to be functioning and be involved at all in doing aspirational things. If that particular payment was pushed over to the general fund, that would take up a good chunk of what we are putting in our aspirational spending category every year. It would be a very, very different city in a lot of ways. So I just want to recognize that. And I'm so glad that there are people that are paying attention, to this. And it is obviously the effects, even though we don't get in front of City Hall and jump around and make an announcement about it. I mean, this year in and year out work, quietly makes a huge, huge difference in the city of Kalamazoo. So I appreciate that discussion, that recognition.
Well, thank you for your comments. I'm going to adjourn this meeting, and I think we're right at the time for our FFE meeting, which is going to be on this same call. We don't have to sign off and re-sign on. Is that correct, Steve?
That's correct.
Okay, so the city meeting is adjourned, and it is 11 o'clock according to I'm going to call the meeting to order for the Kalamazoo Foundation for